o'clock final hour session. It is just after 3 p.m. June 3rd. You have to have my phone on me. I've got just a phone call that's coming in that I just need to send a reply to. I don't have to answer the phone. I just need to listen for it. So my phone's always on silent. Anyway, Mag 7 story. Got some interesting stuff to dissect today. We're sitting here with higher highs. We broke the 3-week stall that the market's been giving us since that U.S.-China trade agreement gap. We melted up a little bit higher. We are pushing towards that 6,000 handle on the SPX. We're pushing towards the 600 handle on the SPY. Can we get there? Tomorrow we have ADP non-farm numbers. Thursday we have jobless claims. Friday we have non-farm numbers. Let's see what happens. All right. So a couple things I wanted to share today. Just pulled some screenshots. I will be talking about this in about 2 weeks, but I'll share this in my Telegram channel and Discord channel today. This is valuations and forward returns. I know this is a bit of an old poll, but it's interesting that we are right here. We certainly have, a pretty resilient market given what we've seen in 2025 so far. Current S&P price to earnings ratio is around 21.10 forward estimate, and that puts us kind of right where I had this yellow box starting. So I've edited this so I can have this yellow box right around that 21 handle. And the reason I think that is important is because what we are seeing most of the time, it's not necessarily disruptive with the 1-year annualized returns, but you can see that it's pretty lackluster when you go to 10 years. So from right now, 2025, if we went out for the next 10 years, your annualized returns are basically flat single digits, like 3 to 5% up, maybe negative 3 to 5% annualized. Like, we are in an interesting chop zone. Now, if you go to 1 year out, you actually have more sprinkled in dots here around the, maybe on the positive side, you get a couple of outliers at 20+%. You get a lot of them just over 10%. But unfortunately, you get a lot of 1-year returns that are in the negatives by 10 to 20%. So that goes along with what we typically see with risk adjusted returns. If you're going to be in the equities market, you're going to play stocks, you're going to invest over a 10-year, 15, 20-year horizon. When valuations are this high, we typically see lackluster returns. So you're looking at maybe a 10, 15, 20% drawdown to maybe get you back to flat, right? So I think it's just going to be a trader's market. 2025 obviously can give us all sorts of things, and off we go. So here is where we're at today for the final hour. S&P is up about 0.6%. As I mentioned, we're just getting back towards the 6,000 handle. If I look back on this chart, we are above the little U.S.-China trade war agreement gap right here. We did just melt up to eclipse those highs. Now, tomorrow is going to be an interesting day. Why is that? Because if we hit these highs here, are we going to hold these highs and still melt up higher, or are we going to give some of it back? Because this could be resistance. Tomorrow is a new day, obviously, right? So nothing is guaranteed. But I ran some interesting numbers today for my daily profit play. We kind of dove into the last 3 years of zero DT data, kind of looked at optimizing the strategy. Ended up taking 2 winners today, which is nice. One was small, one was pretty decent, but it came right up towards the levels we had traded this morning, and gave back a little bit right around this turn. That would have been a little dip around like the 2 o'clock handle. So that helped us out getting our trades back into profit. SPY. I'm looking at a 598 to 600 zone. I don't think we're going to have a push here in the last 53 minutes. If we did, that'd be awesome. I have a trade here that offers about $200 a profit for about a $20 risk. So it's there if I need it. Otherwise, I'm just going to risk the $20, and I've taken the other profits on the day up about $100 or something like that for the day. What else? Qs are up 0.8%. Russell actually, I think, leading the charge. Dow is up 0.5%, so the Dow came back pretty large today. Russell was up around 1.8, 1.9, gave some of it back, but is still hanging in there 1.6%. VIX down to some fresh lows over the last couple of days. So we zoom in on the VIX. We are at 17.74. Will the VIX continue to push a little bit lower going into Friday's non-farm payroll? We'll find out. What else? Bond volatility. Let's take a look. Bonds. I looked at TLT this morning. Sam says, what do you think about up or down play tomorrow? I don't know, man. Honestly, I'm just going to trade probably pretty short term and look at just a. I mean, you can sit here and say like it should go down. It's like, but it hasn't, and it's not. And what news would be disappointing? I mean, if we have like a terrible ADP number, does that drop the market? ADP is never a big concern. I mean, if we move tomorrow, I think it's still like a market maker type day. Maybe Friday or after Friday, getting through this first week of the month. I mean, historically, we typically see this pre-summer push that gets us into March. Look, we had one of the strongest Mays since like 1990. Like no joke, it was like one of the biggest moves, by Mag Seven, mostly led by Mag Seven. I pulled this morning. I think I was going to put this in my Telegram as well. Here's Mag Seven. Okay, Mag 7 still the most consequential story of the stock market, even if they're taking a backseat to geopolitics this year. Months of tariff updates, macro whiplash have stolen attention from the big tech bunch. Mag 7, the MAGS ETF, was down 30+% this year, has already screamed back up. I mean, the reflexive move on mags. I mean, look at what's leading the way. And Nvidia's had a great push to the upside. Meta, I mean, we're not at all-time highs, but we had a big correction and we're back up. They're fighting. I mean, Meta's still spending money. Microsoft's spending money. Microsoft is almost near all-time highs. Broadcom, which just crossed the $1 trillion market cap last year, is back up at all-time highs. Apple, issues with China. Is Apple really going to face a tariff in the U.S.? I don't know. Google basically surviving off that 150 handle back up to like the 165, 170 zone. Amazon, Tesla. I mean, that's a lot of companies here. And I think most of the underperformance on Mag 7, yes, they all took drawdowns in this year, but the entire stock market did too. Right? The entire stock market had drawdown. Tesla got its butt kicked. It was down 55% from all-time highs post-election, where it had like an 85% run and dropped 55% from all-time highs. It just destroyed that stock. But going into earnings essentially put in the bottom around 212, and it ripped up to like 350, 360. You know, so I mean, I was long in ratio spreads and income positions and tried to do some naked puts. And Tesla's been very good to me so far this year, but I was extremely patient on kind of riding out the April drawdown. Here you go. For the latest quarter, Magnificent Seven posted aggregate earnings growth of 27.7% compared to a year ago, which is pretty solid, right? It's slightly below the 32.1% average that's seen over the last 3 quarters. Again, this is Mag 7 earnings, but it outpaced the puny, tiny little. Look at what the rest of the market does. Mag 7 is up 27.7% compared to the other 493 stocks that are at 9.4%. Like these are just growth machines, right? And although, right, we have here that says, um, you know, is it strength? Yeah, so right here at the end. While big tech remains negative in 2025, slightly negative, they gain more than 13% and drag the S&P up with it because their market cap is so high, right? So, I mean, 6 of the 7 names beat expectations. Tesla was the one that was the lagging earnings print, but it was so beat up already that the earnings print was already kind of baked in. Okay. So, I mean, for the most part, I mean, economists, analysts think that the Mag 7 will not necessarily outperform the remaining 493 companies in the S&P, but it's not getting better. Like last year, what was the whole story? Mag 7 is too concentrated. Everyone's in Mag 7. It's too big. It needs to rotate. Well, it did, and then it did broaden out. I mean, you have to remember a broadening out in the markets can also be a drawdown. If you think about this, it's like, okay, everything is outperforming. This is Mag 7. There's 2 ways this plays out, right? This is Mag 7, and we'll say this is 493 companies. Well, everyone thinks this. Everyone thinks that 493 companies is all of a sudden going to start performing better, and Mag 7 either goes sideways or maybe comes back to it. Well, it's the entire stock market. The entire stock market can do this. Mag 7, okay, Mag 7 versus 493. What if it does this? Mag 7, 493. Like the pace and the rate of which they decline, it helps broaden things out and kind of even the playing field, level the playing field a little bit. That's essentially what 2025 was. And so all of the opportunities to buy in April, scary buy, courageous buy, bravery buy, but it still worked out pretty well. And regardless of what you did, if you had the cash to buy in April, you're basically just managing profits right now. I would say you want to preserve some of those profits. I have way more cash than I usually have, but I think it's for good reason. I think as soon as I lose patience in this market, something's going to get a lot more risky for me. If I was fully invested right now, I would hate it. I want to trade options. I want to trade futures. I want to trade my little income trades. I want to generate pretty safe, safe plays without having to take on a bunch of risk. I don't want to be fully allocated because I don't think it'd be a surprise to see another 5% correction in these markets. I don't think it'd be a surprise to see a 5 to 10% correction in these markets. This whole idea with the trade discussions and tariff discussions and what exactly is the global trade war situation, I don't think the U.S. even knows. I think we're trying to get all these countries to align for like a Wednesday deadline. We might pause another 90 days because it gives the market time to breathe, right? We might, I don't know. I don't know. And I'm so sick of speculating on what's going to happen, what's going to come out of Donald Trump's mouth, or what's he going to tweet. It's exhausting. So I think we just have to grind and trade what's in front of us. So, I mean, some themes that I'm watching for right now is if you have your favorite assets, if you have your favorite strategies, you just focus on trading, you know, and that doesn't have to be super complicated. I mean, I have a bunch of different plays. I generally do a nice little filter through my Tasty Trade IV scan. So I look at IVR. I want to see what's actionable here based on high option volume. I want liquid stocks. So I'm looking at IVR, and I want to see if there's some plays in here like Adobe. I mean, I'm interested. It's an expensive stock at $400, but is there a trade there? Maybe. Let's see what else. Let me see if I can find some other ones. FDX, that's FedEx at 220. Maybe. Let me take a look here. What else? Boyle, that's natural gas. UNGM already long. URA has been a really good one to me. Oracle, not bad on Oracle. We're back up to 168. I avoided, took like a 145, 140 ratio spread, made some profit on that one. A lot of those plays I took in April paid out pretty well. Eli Lilly, it's a $750 stock. I don't really do much of that with options. GLD, actually, you know what? Let me take a look at GLD. I haven't looked at GLD in a moment just because I'm still waiting for a pullback to the 200 moving average. But let's go GLD. We're trading at 309. Is it possible for me to get a 265? I didn't really get a lot of premium on this, but the IV on GLD isn't horrible. Got a 44.3. I'm willing to own some more shares. I mean, I don't mind adding positions. I mean, if we hit a 200 moving average, this is like probably the 270 to 265 zone. Let me see what I can get because I can position for a bit of a ratio spread here. Maybe go end of the year. Take a look at gold. Okay, premiums aren't terrible. 265. I mean, I get $1.80 for a naked put. I kind of like the ratio spread idea if I can do something like this. So here's a decent trade. I mean, it's $134 of income to the end of the year, which obviously isn't a lot. But if I do this on 1, 2, 3, 4, 5, 6, 7, 8, maybe 9 accounts here, probably 8 accounts. I do 8 accounts. I make about $1,000 in income if just nothing happens. I also would be willing to allocate. That would be 8 accounts at about 20. Let's see, that'd be 265 minus $1.34 minus 5. I'd own GLD at 258. So if I own shares at 258, that is a correction on gold down to around, I mean, that's about an 18 to 19% correction on gold. I mean, could it go deeper? Yeah, we could go deeper. But I'd love to see a correction where it's like, I don't have to own it, but I've been talking about this for months. It's like, I'm not buying gold. I've been long gold since this breakout over here in 2023 and 2024. I'm just riding this as an asset allocation as well as dollar cost averaging in. This little stretch to the upside, now with a high bar count, I think this is going to consolidate at best, possibly pull back with the highest probability. I think we're going to pull back at least. But if we just consolidate and all these moving averages catch up, any type of dip and go and rally back above, I mean, gold is likely going to look higher. So anyway, is this a great trade? Well, I don't have to require a bunch of buying power on my margin accounts. There is a max loss, but I'd own the shares. Let me look at like 30 days out. If I did take on any shares, could I get any premium if I did like a 30-day covered call? I get $6 to $7 on a covered call if I'm willing to hold it for about 30 days. So I go from a 258 break even to like a quick 252 or 251. I think I could repair it if I was going to allocate 20 grand to it. I think I could turn it for a pretty decent, $300, $400, $500 profit, not have to hold the shares. But it's probably a good income trade. It's about a 91% probability of profit. I do have a profit trap. So if price were to fall, I think I priced this out already, but let me see something here. If I did let's do like a 310 by, this might not work, but a 310 by 305. So 230. Yeah, I'd have to do like a 112 on this trade, which I probably won't end up doing. 26. Yeah, I'm just not getting enough premium for that. Oh, that's July. Never mind. Let me go back to December. Let's go end of the year. If I do a 310 by 305, so that's a $5 debit spread. That gives me a little profit trap. Now, granted, I'm paying $237 for this, but if we stay below this, I will get the $5 credit. If I wanted to go a little bit more asymmetrical, I can do out of the money, like a 305 by 300. This gives me, for $2, I can make $3. That's going to help me lower the cost basis a little bit. Let me see if I go out of the money just a little bit more. So 300 by 295. Now I'm only paying $1.80 to make $320. Okay, so that helps me lower the cost basis. And if I take in the credit on the 265, really? Yeah, I'd have to do like a 112. I don't want 200 shares. I don't want to put in 40 grand in gold. So I'd rather just do the ratio spread. So I think this looks better if I do the 270 by 265 and increase this one. So that's a pretty good looking trade, in my opinion. About a 91% chance of profit. It does have a profit trap if gold is going to come back and retest the 200 moving average. If we stayed below, 270, then we have some potential profit trap there if we get assigned. We have plenty of wiggle room. I mean, gold would have to essentially drop 17 or 18% for me to take on any real risk. I think globally, gold is probably in a pretty safe place. Okay. What's up, Kevin? How are you? Sam says we need a pullback to reduce risk. Yeah, I mean, I think we need a pullback. I've been saying it now for 3 weeks and we haven't had one. So, I kind of, in my experience, it's like by the time I lose patience, which I rarely do, but by the time I'm like, you know what, screw it, it's a melt up. I'm smart enough that I'm not going to chase the melt up, but it's around that time where the market is just fudge it. It's going to go higher, and then it doesn't. I mean, I looked at it today. My daily time frame is certainly is overextended. We've got overbought conditions on the daily. We have divergence. Topping patterns are emerging all over the place on daily time frames. The weekly chart still has a little bit of movement. Like we could still melt up on the weekly. I just think it would be a very slow grind. But I think a pullback is still likely. This potential like July trade war. I mean, this week on Wednesday, maybe this whole idea of like, do we find out how many countries gave the U.S. a call today, trying to get a trade deal together by Wednesday? What if they don't? What if nobody shows up to the party, right? Like we are saying, look, we're hosting a party, and nobody shows up. What do? We just pause again? I have no idea. So I mean, there's all sorts of reasons for the market to have some risk and some fragility. I think the market is kind of melting up on some thin ice. I don't think that earnings necessarily. Yes, they were fine. Mag 7 came back strong. The biggest companies in the world continue to do well. There's companies are spending money, but it's like, is it justified? Is it warranted? Clearly, the trade narrative is changed. Like the Trump administration is way different narrative commentary than it was 2 months ago. So I think that's where this market is still looking better. You have fiscal spending going on globally. You've got rising yields. We'll see, and maybe things get a little nastier at the end of this year. Maybe money supply isn't as buoyant and as aggressive as everyone sees it right now. Money supply going up. If I see like a global money supply indicator here, let me go money supply. So that's U.S. money supply. I'm looking for global. Is there global M2? Well, I know US is up. So there's our US money supply. If I go China money supply, way up, right? I mean, and I'm not saying I'm discounting the world, but if US and China money supply is up, okay, fine. But I do wonder if this is a front run. If we go Europe money supply, usually a continent that's pretty, focused on austerity, money supply, Japan money supply, highs, right? So was this a reaction to a potential global trade war? Does this change? So all of a sudden we start to see, it stalls off again. I don't know. So this could all be like lagging data, but if it comes to reality, like maybe we start to see that it's not as awesome and liquid and as things appear. That being said, though, there are inflows. I mean, if we go to like ETFs and ETF inflows, so where's this website? Pretty simple website, usually pretty free. ETF stream, maybe this is it. That's not really what I want, but anyway, let's see if we can go fudge. Let's see, equities, commodities. That's not it. There is like an ETF tracker. This one, yeah, duh, ETF.com. It's this one. So if we take a look at SPY, and let's just go beginning of the year. Okay, let's just go now. So year to date, submit. And let's see if we can get, let's go monthly. Weekly, maybe a bit more precise. So all year, weekly inflows. So outflows in March, big inflows in April. That was one of the worst days in the market was April 7th. We had huge inflows there. It's obviously been a little bit more outflowy. Thought that was interesting. So net flows, let's go back into sort this out. So according to this, the SPY is experiencing more outflows just in the last couple weeks. Okay. Hasn't really changed price action. I mean, I'm looking at my gamma levels, liquidity levels every day. The numbers are not big. We don't have crazy high volume. I don't have crazy high gamma levels. The market's just kind of in this odd melt up, and it's challenging because like the hard part is a melt up. I mean, if you follow volatility, when you're in like a slow, grindy melt up, volatility gets really, really low, right? And all it takes is like one thing to change the course of that. Volatility goes from this really low implied volatility to really large implied volatility. And it's a bit of a shock move, and nobody knows when the heck it's going to happen. But there is a ton of reasons for the market to have some type of correction. I look at it from the charts and the technicals. I look at it all these, this plethora of reasons we have like sprinkled in every single day with like the bear market commentary. But anyway, it's like until price shows up to do it, I just don't think it's worth calling the top. And I'm not interested in calling the top. I'm just hoping that we have a pullback. And this is what I keep talking about. I just hope we have a pullback, right? So going sideways here for a couple of weeks, I'm hoping that we have a pullback. Like, let's at least respect the range. I mentioned this before. Like, are we going to hit all-time highs before we have? And I think I posed this question a couple weeks ago. I'll ask it again. Are we going to hit all-time highs before we fill this U.S.-China trade gap? So that's the question. Go ahead and answer it in the chat for me. Are we going to hit all-time highs, we'll say in the S&P, or are we going to fill the U.S.-China agreement gap? What do you think? So type in ATH if you think we're going to all-time highs, and type in gap if you think we're going to fill the gap. There's no right or wrong answer. It's really just your opinion. I would like to fill the gap before we go to all-time highs. If we get to all-time highs, I think we're going back to the gap. I mean, even if this is going to be a bullish pattern, excuse me, a bullish pattern is still left shoulder, head to neckline, right shoulder if we have a bullish pattern. Okay. Also, could this turn into a range where we don't go anywhere? We hit the highs, we come back into the halfway point. Maybe it's not as bad as people think, but we just kind of oscillate around here. Maybe the market returns jack squat in 2025. I don't think that's the case if we pass this big, beautiful abomination bill that Elon Musk thinks is garbage. The guy worked for Doge, and he seems to be disappointed in what the government's actually doing, which is increasing the debt ceiling, increasing deficits, and passing a bunch of garbage that everyone's going to vote on. Why? Because it's easier to stay, in power and stay in your seat and not vote against anything against the grain. So it doesn't help the fiscal situation. It doesn't help this whole idea of, austerity or government responsibility and accountability. It's out the window with this big, beautiful bill. Um, so and it hasn't been passed yet, but if the pressure is like vote, accept it, it's good for the American people. Is it though? I don't think it really does anything to help everybody. I think it's going to be more of the same. If we're lucky, and I'll talk about this more in a couple weeks here, but if we're lucky that the markets can do something like this, that's not very well drawn. If we're lucky, we pass this big, beautiful bill, and all of a sudden everybody can get some benefits, right? It's not really a tax cut plan, it's more of a tax extension plan. But if this is like let's say the top 10% here and the bottom 90% here, can we actually have an inflection point where, yes, I understand it's hard for something good to happen and the top 10% don't benefit? And could it be a benefit for everybody? Would this be an E-shaped recovery if we just kind of draw this out? Is that an E-shaped recovery as opposed to the K-shaped recovery? This is what it's been like since COVID. K-shaped is top 10% crushing it, bottom 90% living paycheck to paycheck, paying for higher prices, inflation, struggling. So can we at least stop that and maybe improve the bottom while also, benefiting the top, which usually they always benefit? I mean, that'd be a bit of a win-win despite the complete gap between, the top 10% and the bottom 90%. Okay. So we shall see. But let me see what we got for questions here. I've got all-time highs. I did not think so. Buy now. Okay. Depends on whether Trump keeps. That's not going to happen. All-time highs. All-time highs. Unfortunately, that the markets are in. Gap says Ranjit. Terms of a catalyst. Let's see here. Trump opening his mouth at China not playing ball. I agree. I mean, anything with U.S. China, and that's really how this whole trade war started. It was really trying to get China into more of like a controlled box. China is just insanely aggressive with intellectual property, recreating, reproducing. I mean, everyone calls it intellectual property theft. Sure. I mean, if you have a company that makes $5 to $10 million in sales and you have something that is efficient, it's probably a clone. Like China probably has a clone of it. It has been a problem. So this whole trade war of like blanketing it for the entire world was really a play to get China involved. We don't know the true semantics. We don't know the optics. I've said this for years. I think that China, US have to find a way to coexist. But if all of a sudden who control, like China controls about 90+% of like refined minerals and resources, like important stuff for this whole AI build and this AI infrastructure and what the future looks like, do we get some of that? Do we take away some of that market share? Or is it we just need them to play ball as a manufacturer and we are the largest consumer and we need them to come to some more agreeable terms? Look, it's a big deal. But I don't think that this whole idea of tariffs is going to fix anything. If anything, it's way more friction, it's way more disruptive. But I agree that if Trump is relatively quiet, then the markets just think like, you know what, U.S. and China will figure it out. There's no damaging news. Let's see how this all plays out. Melt up, melt up, melt up. Right? U.S. is going to add more to the deficits. They're going to keep spending. Fiscal policy prevails. Europe is now spending money. China's spending money. So all that to me is, yes, a potential melt up. That melt up to me is on borrowed time, but I don't think we go necessarily way, way, way down. I think we just have like a nasty correction, you know? So I would just say buckle up. I mean, what could happen? I mean, I've looked at this all sorts of different ways on the technical side. Let me just draw like a big thick line here. If we went from connecting these highs to taking this low or this low and connecting these lows, obviously that's not picture perfect at the lows. This might be more picture perfect at the lows. How disruptive would it be to see the market drift to all-time highs and then pull back to the halfway point? Then we have the bear market rally with lower highs and lower lows, and we reset all the way back down to 2025 April lows, right? And just imagine the retail crowd. Like, think about how smart the retail crowd's been looking. You buy the dip, you get paid. You buy the dip, you get paid. What if the market decides that this is no longer going to be a melt up high, but rather the retail crowd that buys here all of a sudden experiences another flush down, and then they buy here, they experience another flush down. That's going to ruin all the confidence of the retail crowd, right? Then reality sets in. Like, I just think we're so close to, like, reality is not good, but the market's not reality. The market's not the real economy. We know that. We know that. So you just have to trade it. And I'm, again, it's 5+ months into this year, and it seems like it's already been, an eternity. But there's still trades to be taken. There's still things to watch. There's still ways to protect yourself. I think that's the most important thing is you got to protect yourself. You don't want to do anything silly. I'm not risk averse. I like to take good trades, but I am sitting on some cash to hopefully see a better opportunity than a freaking all-time high melt up. You know, that to me feels like we are on like thin ice for this bull market, and it's obviously like flat for the year. I mean, we're just now inching out maybe a 2 to 3% year so far. If we look at the monthly time frame, what's the yearly candle look like so far? Here's our yearly candle. So far the S&P, after all the drama, it's up around maybe 1.21%. Now, I talked about this a couple weeks ago. I'm trying to keep the charts very clean. The last time we had an insane melt up would have been 2019. Let me use this black line here. Let's see here. So 2019, 2020 with the COVID low. Obviously, COVID was, you had the courage and the cash to buy. You made a crap ton of money in COVID. 2020, 2021 is a continuation and the momentum of that. So this run, not counting the discount lows, like this was like a 90% move. It was a crazy, crazy run, obviously followed by 2022. But the start of 2019, this is up 93%. And I'm looking at this year with what happened in 2023, what happened in 2024, what has happened so far in 2025. If we continue to melt up in 2025, maybe we hit 8 to 10% for the year. Okay. What's that look like from the bottom of 2022? If we hit, let's say, let me get a number here. Let's go up like 10% for the year. Let's say this after a 20+%. Think about this: 20+% pullback reflexively goes up about 10% for the year. That's about right for risk adjusted return. Okay. So if we go, give me a second here. Give me a second. Open. See if this guy's in. I had to let somebody in the office door. All right. I might need like 60 seconds to make sure he's in. I don't want to lose my train of thought. So from the lows of 2020, the start of 2023, essentially, into currently, let me get a measurement off of this year. If we went up, year to date 10%. There's our start of the year. Let's say we go up around 10%. That lands us around 6,500. Okay, lands us about 6,500. What does that melt up? 6,500 puts us up around 67% from the bottom of 2023. The start of 2023, not the bottom, the start. Okay. So if this gets insane, then we have had higher levels, right? This was 92%. Do we have 2025 as a year that just keeps going and going and going, and we have another like 80 to 90% run from 2023 to 2024 to this wild and crazy 2025? Nobody knows, I mean, I think based on the current price to earnings, based on forward returns, anything can happen. And I think that's why, Wall Street and analysts are so far off, which like we could be up here for the year and we could be down here for the year. I think that it's pretty safe to say that the April lows are likely not going to be broken unless something really, really breaks them. Just the trade war stuff, like that was a flinch. That was a break in the bond market for a moment. That was the basis trade imploding. That was the entire world like, okay, if we got to do business with the U.S., what are we going to do? And that's what happened in April 7th. Post Liberation Day was April 2nd, but post April 7th, like the whole world kind of pivoted hard. Now, does the U.S. become another just high flying index? Okay. So all this stuff it's just crazy to think about, but there's still trades. And honestly, look, I'll say this, even if, okay, even if I can't get this market to, blow me away with all time highs, but rather just don't implode. And I don't know, like in here, I'll ask you this, can you make money in here? If this market just goes sideways for a few more weeks, maybe goes up, maybe goes down, can anybody make money in here? Because I can. Right? It may not be like all the money with like, just deploying crazy options and sell some puts and do some spreads and everything wins over. I mean, over like a 60-day window, I had like 99% of my trades were winners. Well, that was because of the timing of a bottom, right? Like market breadth was extremely weak. It was a great timing opportunity. The pain trade and the capitulation was certainly felt. It wasn't easy, but it took some time, and 30 to 60 days later, like things were great. But my point is, like, even if this is all we get, I just don't like this environment. This is not my favorite environment to trade. I think that just this slow, everyday grind is really frustrating. But there will be trades in this market. I mean, that is literally why I built this thing called a pinch point scanner that just spoon feeds me really good coiled positions where price is likely going to go somewhere. So what do I do with that? Well, I freaking trade it. If prices are coiling and coiling and coiling, that volatility has to go somewhere. So that's what I'm trying to trade. So individual stocks, there will be trades. Indexes, there will be opportunities. My favorite stocks, there will be opportunities. So I will do my best to stay patient. I don't have like a broad market direction. I think that it's probably more frustrating to see the melt up right now than it is to, I mean, look, and what's funny is even a pullback here, like we talk about it right now, June 3rd, live in the session. And if this market were to pull back 5%, nobody's going to like it. It's like this market, it pulls back like half of 1%, and then it's like, go higher. It pulls back 1%, it's like, please go higher. It pulls back 3, 4, 5%, everyone loses their mind, like, what is happening? Right? It's like the sentiment swings that we see now are just the highest I've ever seen. The extreme bearishness, the extreme bullishness, it's all over the map. And that's really difficult. That just means like it's just easy to get super emotional in your trading. So, I mean, think about that. If we had something that comes back aggressively to fill this gap, as well as I do, the news is not going to be good, right? The news is going to be terrible. And whatever it is, whether it's Trump or it's China, whether it's the whole world, whether it's something with the Fed, whether it's, I don't know. Wait, maybe the big beautiful bill doesn't pass. I have no idea. It probably will, right? I mean, that'd be like saying like we're gonna have a debt ceiling debate, and the Congress and like Congress, so House and Senate are going to not lift the debt ceiling, and we're gonna have a shutdown. Like this could happen. Did we avoid a government shutdown already this year? I think we pushed it out to like July or September. So anyway, whatever. All the layoffs that happened during Doge's tenure for the first 3-4 months of the year, all come to reality in like September. So this like continuing jobless claims, initial jobless claims, we start to watch those. Like, what's the U.S. economy doing? So anyway, I saw that. Yeah, Atlanta Fed like big upside, right? The GDP switch like went from negative to now it's like 2-3%. I think on stocks, what are up today, it looks like the market makers are pivoting all kinds of different sectors. Stocks pulling up this market. I mean, let's look at the sectors. So look at the ETFs. Let's see what's performing well. Let's go year to date. I mean, this is not typically an aggressive bull market when you see industrials leading the sectors this year and utilities leading the sectors. This is not a bull market. Now, this is a little bit broader than what we saw with tech and Mag 7 essentially carrying the entire torch for the market. But look at this, right? Staples, usually not super exciting. Okay, what's communication services? Probably mostly Netflix. I think it's mostly Netflix. Yeah, so Netflix is leading the way at all-time highs. Meta, I mean, you put Meta and Netflix at the top of this with weight. Look at this weight. So you put Meta, Google, Netflix on the top of this thing. That is how much weight in this sector? It's crazy, right? 16.63 plus 8.54 plus 7.66 plus 6.97. You have Meta, Google, Netflix. 40% of this sector is all tied in with those three companies. Meta's performing well after the April 7th bottom. Google's come off the lows. Netflix is at all-time highs right now. 40% of course is doing well, but it's not outperforming, right? It's not outperforming. You look at what is performing well, it's boring stuff. Staples, boring stuff. Financials, boring stuff. Industrials, are you kidding me? GE Aerospace, RTX, Uber, Caterpillar. I mean, this is either a good thing for industrials because we're building things out. There's actually growth potential, but they're usually not high flying stocks. Utilities, talk about boring. Okay, next era down for the year, but look at Constellation up 40%. Look at Vistacorp up 21%. A lot of these are high debt, but kind of cash cow dividend stocks. They don't move a lot. They're typically lower beta. But again, this is the sector snapshot. This is what's leading this year. It's not tech. Like Mag 7 got beat up aggressively, but it rotated back hard. But you're seeing things that are kind of leading the charge that don't necessarily lead to sustainable markets. This to me feels a lot like, okay, this is a rotation into maybe the final legs of a maybe broader bull market. But I don't know if this is sustainable, you know? So anyway, it's a lot of guessing, and that's obviously like the market. You guess, you speculate, you forecast, you predict, you project. Just don't trade like an idiot. It's like this market is literally offering up more opportunities. Look, I'm at all-time highs for the year again. Like I'm sitting here like sounding like I hate the markets. I'm like I'm sitting at fresh highs for the year, but I'm just not as aggressive. I went from like a 205 high to now 250. So I'm up another $45,000 for the year. Like that's okay. But I wish it could be more. I want a position to know like I've got better income strategies. But this is going to be like a slow, steady grind if we continue to melt up. I'll probably get this up to like 260, 270 if we get all-time highs. Um, I'd like to make more money than that, you know? Excuse me. So anyway, we will see. If I have an opportunity to buy a dip, I will scale in for dips. But that could be a variety of levels. I like this gap fill. I like this gap fill. I like this gap fill. And I'm trying to basically plot any of these trades here. If we have an increase of volatility, I don't care if we don't get back down to April lows. I'm essentially saying that by December of this year, I don't think we're going to be at April lows. And if we are at April lows, I'm willing to own some shares and I'll fricking flip it. There's ways to do wheel strategies. I mean, everyone talks about the wheel strategy. You just sell a put. If you get a sign, you sell a covered call. That's a wheel strategy. Well, I'm going to do something a little bit more creative. If we come down to this area, I'm going to put in a bear trap and put in my naked put or my wheel strategy, like step one. But this is a bear trap to give me some income. This is my put that I would say I'm willing to own the shares here. If it stays in the middle, I get profit on the bear trap and I get profit on the put. And so maybe what starts out to be maybe a $200 trade is going to offer me, maybe $700 of profit. I do that on, let's say 10 accounts. I make $7,000 and this happens over like maybe a 60-day window. Okay. So if I can do this another 4 times, make another, $25,000 to $30,000, like it's just trading. It's just using your capital efficiently, not over risking, putting levels out there that are pretty safe and just not I just don't want to overbite on these markets, you know? So I don't know. Am I boring you with like I'm pretty conservative right now, but I think it's for good reason because this market is making me like uncomfortable with how it doesn't want to do anything other than melt up, and I don't think that it's justified. And so what I'm not doing is I'm not bearish and I'm not calling the top. Right? If this market wants to pull back, that is fine. I will be waiting with open arms to position for a dip. But if this market melts up, I'm just going to keep selling covered calls. I'm going to keep taking profits off on my debit spreads and my credit spreads and my naked puts. Mohammed, yes, it's a 111. It's a modified 111. I could do a 111 or a 1111. I like to do kind of the modified so I can have a defined risk with my IRA accounts. So anyway, I think it's a factor of how uncertainty averse. Yeah, I mean, we want like there's never certainty. I was pretty well. I was pretty certain through 2020 after the dip that it was a good time to buy. I did not ride that thing as long as I should have. I mean, 2020, I rode that thing for like 60, 90 days. I went out for leaps on some. I rode it for like as much as a year. I had more triple digit winners in 2020 than I've had probably my entire career. That was an anomaly type year. So, I mean, it was great, but 2020, 2021, it just was a crazy momentum melt up year. 2022 was a reality check. It was more of a bond market correction that dragged equities down with it than it was a full on bear market. But you can see how the markets came out of that in 2022. We had a Q4 liftoff with Mag 7 that led us out of the way. Mag 7 led in 2023. Everything else went with it. We had about two broad market pushes in 2023. 2024 was more of the melt up. It just had some hiccups along the way. So here we are again after a self-inflicted trade war wound, back up above these moving averages, which to me, this is where the resistance was. Now the resistance has been broken, right? This is where the resistance has been broken. So if we're greater than the resistance now, it's like I'm hoping to see it as support. But even if we have a run up to a pullback to find support, it's like, do we hold it? Do we find it? I hope we can. There's trades to be made in here. There's income to be made, right? So I will just kind of wrap up today's final hour session with this. Do you feel like you have the right strategies to get you income? If this market goes up, that's pretty easy money. If this market goes down, you'll feel the pain of this if you're over leveraged and over invested, right? If the market is just slow and grindy, whether it's sideways or up or down, but it just barely moves, there's income methods. So I have a blend of kind of all of them. Like my core positions, I sell a lot of options on every kind of 30 to 60 days. I'm adding more kind of, adding little bits to my option portfolio to like improve my core positions. Um, I do take a lot of just one-off income trades. I use a lot of options for that. But I think I'm fine here. I'm happy. If I know and I'm confident the market's going up, then I'm obviously more aggressive. I just don't know that this is going to happen. So that's like a big question mark for me. Anything to the downside, I've got enough cash on the sideline. Like I want this. Like this would be, excuse me. I'm going to draw this. This is my smile with a little bit of like drool. I'm drooling. I'm salivating for something where I can buy some dips. I can position for this and still get, a better move. I want to deploy some more capital. I just want a better opportunity to do it. Right? Yeah. So anyway, I just want to make sure you have strategies, right? If you feel comfortable navigating up, down, sideways, good. If you're comfortable with strategies that help you navigate up, down, sideways, fast or slow, good. I probably do better in a slow environment. I probably do better in a steady environment. I probably do better when I feel like I've got a bottom to trade from or a top that I'm kind of comfortable hedging with. Right now, it's like we're in a no man's land island that maybe melts up, maybe pulls back. What's the summaries from today? I'm going to do a poll and I'm going to do this right now. Let me see if I can go to this is my Telegram channel. I'm going to see if I can build a poll. So create poll. Okay, S&P 500. So community question. Will the S&P 500 hit all-time highs? Okay, I'll put what will happen first. What will happen first? S&P hits all-time highs or US China trade agreement gap is filled. So we have pull options. We have all-time highs. We have U.S. China trade agreement gap. Okay, and that's it. It's one or the other. So there's my poll. Here's my Discord. If you'd like to pop in here and answer it for me, I'm just curious. Like, what's 2,000 people going to say? So here is my Chris Pulver Telegram. There you go. So I want to hear from you. Okay, that way I've got some evidence of like what's the community going to say. So get some votes in here. Okay. So and again, this is earmarked for today. So we're looking at June 3rd. So that's when we had this conversation. Let's see how this plays out. I mean, honestly, it certainly feels like this market doesn't give a funyun about anything other than trying to go to all-time highs. I just don't think this would be it wouldn't be as exciting nor celebrated as proudly as a dip or a pullback that kind of gets us. I don't know. I, as an investor, would like a chance to buy the dip. Okay. If we go up to these highs, I'm way more skeptical on like, why would I buy the dip that's already at all-time highs? I want to see a pullback first. Like, give me a bigger move. Then I'll buy the dip. So in a way, I'm hoping that like maybe we have a disappointment in non-farm payroll. I don't know. The numbers are always fudged anyway. The revisions are atrocious. It'll print on Friday like 200,000 jobs. Everything was great, and then next non-farm it's going to be revised down to like 120. It's hard to believe the numbers. So you never know. But we're so close. It's like the S&P is so close. I will say that the Russell is just sitting at resistance right now. So if the Russell can't catch up, if this goes sideways on the Russell or rejects off the 200 moving average, especially if the Fed's not looking to cut or anything, not right away. I mean, maybe September they cut. But if the Russell can't break above this trend line in this 200 moving average, then we have the Dow, which is still behind the 8 ball. We've got the Qs that have just screamed higher. Okay, so the Qs are very close. The S&P is very close, and mostly it's leading by earnings were mostly solid. Consensus was fine. Most companies beat. Forward guidance was essentially a non-thing. Nobody offered forward guidance. Why? Because nobody knew what the hell to say. Trade war uncertainty. How do we predict for this? How do we plan for this? You don't. You just think like, look, Q1 was good. We beat top and bottom estimates. Hooray! We'll keep your mouth shut. I'm sure that the transcripts read very little about trade war. They may be focused on AI a little bit if companies are pivoting that way. So let's entertain the possibility of lower lows than the April lows. How would that happen? I mean, could it happen? Sure. I will say this though: if you expect or see April lows that are going to break, it's not a good thing. I mean, from a technical picture, if we break these April lows, I've got like plenty of charts that I talked about this. I did this on a lot of trading view videos. There's nothing good happening below these lows. If we break April lows, I hate to say it, but remember this whole COVID explosion? This was all funny money that came into the market. So I think this goes. If this party ends, I think this market comes all the way back to where this whole party got stupid. The whole party got stupid and drunk and intoxicated in COVID 2020. Okay. We had like the fastest, ugliest bear market with the fastest recovery ever. The global economy dumped $6 trillion into the markets and it just melted up from there. So if this money is going to finally get its way out of the system, that's where it goes. And that, like, nobody wants to see that, you know? So it would have to be something catastrophic. It'd have to be something where it just changes the entire dynamic of the market. We'd have to have little to no faith. We'd have to have like almost global failure in some way, shape, or form for that to really happen. I think right now, I mean, if countries are smart, they know that at the end of the day, they're systemically tied together. The US and China have to play nice. Whether US is trying to stay number one, whether China is trying to become number one, they have to still work together, right? Even if China is number one, we still are probably going to be number two by a long shot. And I just think it's crazy to think like that China's going to move everything all like be its own moat and nobody needs the U.S. anymore. I don't know. I don't think that's a possibility. And certainly the U.S. is not going down without a fight. And if the U.S. is really threatened, what are we going to do? We're probably going to bomb somebody. You know, I mean, it's like, it's horrible what global power actually looks like. But my point is, if we retest April lows, we better hold those April lows. Excuse me. If we hold those April lows, then we still have a semblance of a market. But this to me would be a bit more extreme, like a high to low that goes back to the same type of chop fest we had back in 2015 and 16. Right? Go back to 2015 and 16, and the market was sideways. There you go. Sideways market. If we have that after getting out of a crisis, we go up and we have a melt up, right? So we have a sideways market for 2 years, and then finally 2017 it breaks out. Then we go sideways, break out, pull back, break. It's just I've kept this pretty easy, you know. The trend line here is way out here. The previous resistance, you know, pre-COVID is right out here. If we break the April lows, nothing looks good, right? Nothing looks good. And again, I'm not predicting that. I'm not trading for that. I don't know. I mean, I don't know what would be the cause of it, but you know what? That's probably why it's called a black swan event, because you don't see it coming, right? You can have all these reasons, and the perma bears can tell you, we told you, but they might be years of waiting. Look, perma bears got their wishes in 2022 for a little correction. Perma bears got their wishes for a month in 2025. Perma bears got their wishes in 2020 for a month. But other than that, perma bears are idiots, because all they do is fight the grain of the market, and they fight the flow of the market where this thing finds a way to go higher. So if you're a perma bear, you better have your chances to take your profits, because otherwise that's all you get. You get like a 1 to 2 month window to be right, and then it's just years of grinding higher. So anyway, that's all. So honestly, I have no idea what would cause it. I just know it wouldn't be good, you know, and it could be a lot of things right now. But we closed up today, you know, 0.58% in the S&P. Nasdaq's up almost 0.8. Dow's up 0.52. Russell's up 1.6. VIX is down. Take a look at currency strength today. Dollar and CAD on top. Swiss and Japanese yen weaker. So as far as like risk on, risk off, I mean, well, I take that back. I just know that your safe haven currencies were at the bottom of the food chain today. So it wasn't necessarily all risk on, because I'd expect Australia and New Zealand to perform a little bit better in a risk on environment, but that's partly because the dollar was stronger today. But it's nice to see the Swiss and the Japanese yen weaker, because those are certainly the best safe haven currency pairs in FX land right now. Okay. All right. Well, hey, I got to run for this final hour. I posted the link for my Telegram channel. Let's see you get some votes in here. And I'm curious. So I want to see where these votes tally. How the heck do I find it out? Statistics. Nope. Oh, I can turn it on. Okay, so I'm gonna try to get, you know, I don't know. Let's say we get a couple hundred votes in here, then I'll stop the poll. We'll try to talk about this again tomorrow. Okay. All right, I'll let you go for the final hour. I'm jumping into my masterclass for Pinch Point Scanner. We're gonna see if we got some new setups for today. Let's have a look. Let's do some pricing, and I will see you in just a couple minutes. Okay. All right. Appreciate it, Lee. Thanks, Sam. Pimp. Thanks. Everyone else watching today, kindly hit that thumbs up button for me on youtube.com/Chris Pulver, youtube.com/Financial Wars, and we will see you again mañana.